There is a disease that infects the mind of almost every person who decides to enter the world of investing. It's a cognitive sickness, a fever of optimism that hijacks the rational brain and replaces it with pure, unadulterated hope. It's the disease of the good story. You hear it from a friend, you see it on a financial news network, you read a compelling article about a visionary CEO with a world-changing product. The narrative is perfect. The future seems not just possible, but inevitable. And in that moment, a powerful impulse takes over. Your brokerage app is open. Your finger hovers over the buy button. You feel a surge of adrenaline, a cocktail of greed, and the fear of missing out. You click it. And in that instant, without a moment of systematic thought, you have likely just made one of the most catastrophic financial mistakes of your life. You didn't just buy a stock. You bought a lottery ticket wrapped in a story. This impulse, this emotional decision-making, is the single greatest destroyer of wealth for the retail investor. It turns the stock market, a powerful engine for building generational wealth, into a casino where the house always wins. But what if there were a vaccine for this disease? A simple, powerful, and unfailing antidote that could immunize you from the emotional highs and lows that wreck portfolios. There is. It's not a secret algorithm, it's not an expensive trading terminal, and it has nothing to do with predicting the future. It's a tool so simple that most people dismiss it as elementary, yet so profound that it forms the bedrock of fortunes built by the world's greatest investors, including Warren Buffett himself. It is the humble checklist. The principle is this. Before you even consider buying a single share of any company, you must run it through a rigorous, predefined checklist of your own core criteria. This isn't a suggestion, it is an ironclad law. This checklist acts as a firewall between your emotions and your money. It forces discipline when you feel impulsive. It forces rationality when you feel euphoric. It transforms you from a gambler reacting to stories into a business owner making a calculated acquisition. By creating and adhering to your own personalized investment checklist, you will fundamentally rewire your brain, ensuring that every single asset you bring into your portfolio has passed a gauntlet of your highest standards. This single habit will not just reduce the number of your mistakes, it will nearly eliminate the catastrophic ones, the ones that set you back years on your journey to financial freedom. This is the final promise, that a simple piece of paper, a document you create for yourself, can be the most powerful tool in your entire financial arsenal. Our journey begins with the most fundamental question, the absolute starting point of any sound investment process, and the first pillar of our checklist. It is the principle of the circle of competence. Before you analyze a balance sheet, before you calculate a price-to-earnings ratio, before you even read the latest quarterly report, you must be able to answer a simple question with unwavering honesty. Do I truly understand this business? Not the stock ticker, not the story, the business. How it makes money, day in and day out. How it defends itself against competition. What makes its customers come back again and again. To illustrate the immense power of this principle, we must travel back in time to the late 1990s. The world was caught in a frenzy, a technological gold rush unlike anything seen before. It was the dot-com bubble. Companies with no profits, no clear business models, and often no revenue were going public and seeing their valuations soar into the billions. It was a new paradigm, they said. Old metrics didn't apply. This was about eyeballs, about network effects, about capturing the future. And as the NASDAQ Composite Index screamed upwards, doubling and then tripling, the pressure to join the party was immense. The greatest financial minds of the era were all in. Professional money managers, analysts, and the media scorned anyone who sat on the sidelines. And sitting firmly on the sidelines, looking distinctly old-fashioned, was Warren Buffett. Journalists openly mocked him. An article in Barron's in late 1999 was titled, "What's Wrong, Warren?" It suggested his methods were outdated, that he had lost his touch, that he just didn't get the new economy. His company, Berkshire Hathaway, was dramatically underperforming the market. His shareholders were getting restless. The pressure on him was unimaginable. And what was his reason for avoiding the tech bonanza? It was profoundly simple. He would state, time and again, "I don't understand them." He couldn't project with any degree of certainty what a company like Pets.com or Webvan would be earning in 10 years. He couldn't understand their competitive advantages, or how they would fend off rivals once the venture capital money ran out. He admitted that the executives of these companies, like Bill Gates at Microsoft, were brilliant people. But he said, "I have no special insight into the computer and software business." So he didn't invest. He stuck to what he knew. He continued to own businesses like Coca-Cola, Gillette, and the Washington Post. He could tell you exactly how Coke made money. He understood the power of its brand, a moat built over a century. He understood the recurring revenue from a man buying a razor blade every morning. These were simple, understandable businesses within his circle of competence. While the world saw him as a dinosaur, he was calmly applying the first and most important item on his mental checklist. Do I understand this? The answer for tech stocks was a resounding no, and so he did nothing. Then, in March of 2000, the bubble burst. The Nasdaq, which had peaked above 5,000, began a brutal and unforgiving collapse. By 2002, it had fallen nearly 80%. An estimated $5 trillion in market value evaporated. Companies that were once worth billions went bankrupt. The new paradigm was revealed to be the same old speculative mania, and Warren Buffett, the man who had been mocked, was vindicated. His refusal to step outside his circle of competence didn't just save him from losses, it preserved his capital, allowing him to go on a buying spree in the aftermath, picking up wonderful businesses at bargain prices. That single decision, rooted in intellectual honesty, was one of the most profitable moves of his career, not because of what he bought, but because of what he refused to buy. The psychological principle underpinning the circle of competence is a powerful defense against two of the most destructive cognitive biases that plague investors: the fear of missing out, or FOMO, and confirmation bias. During the dot-com bubble, FOMO was at epidemic levels. It's a primal, herd-based instinct. You see your neighbors, your friends, your colleagues getting rich buying stocks you've never heard of. Every day, the news reports on some new tech IPO that has doubled on its first day of trading. The feeling of being left behind is agonizing. It creates an intense psychological pressure to abandon your process and jump on the bandwagon, regardless of the risk. Your brain screams that every day you wait, you are losing out on life-changing wealth. This feeling overrides logic. The fear of missing a potential gain becomes more powerful than the fear of a potential loss. Buffett's strict adherence to his circle of competence was his shield. He had pre-committed to a rule. If he didn't understand it, he wouldn't buy it. This rule didn't eliminate the feeling of FOMO, but it gave him a logical framework to invalidate that feeling. He could tell himself, yes, others are making money, but they are playing a game I don't understand. I will stick to the game I know I can win. The second bias is confirmation bias. This is our tendency to seek out and interpret information that confirms our pre-existing beliefs. When an investor gets excited about a story, say a revolutionary new technology, they will subconsciously start looking for evidence that supports their initial excitement. They will read the optimistic articles, watch the bullish interviews with the CEO, and dismiss the skeptical reports as sour grapes from people who don't get it. They aren't conducting objective due diligence, they are building a case to justify the decision they have already emotionally made. A checklist item demanding you prove your understanding of the business short-circuits this process. It forces you to seek out disconfirming evidence. When you have to explain the business model, the key risks, and the competitive landscape, you are forced to confront the gaps in your knowledge. The act of trying to prove you are inside your circle of competence often reveals, quite starkly, that you are miles outside of it. This creates a moment of intellectual honesty that is crucial for avoiding bad decisions. It replaces the question, "Do I want to own this?" with the far more important question, "Am I qualified to own this?" So how do we translate this into a practical, applied mental model? How do you build the circle of competence section of your own investment checklist? This is your blueprint. It's a series of non-negotiable questions you must answer in writing before proceeding with any further analysis. Step 1. The 10-year-old test. Can you explain, in simple terms that a 10-year-old could understand, exactly how this company makes money? If you find yourself using jargon, buzzwords, or convoluted explanations, that is a massive red flag. For a company like Hershey, it's simple. They make chocolate and candy and sell it to stores where people buy it. For a company like Walmart, they buy products in huge quantities to get a low price, and then sell them in their giant stores for a little bit more, making a tiny profit on each item but selling billions of items. Now, try that with a complex derivatives trading firm or a biotech company in phase 2 trials for a novel gene therapy. If you can't simplify it, you don't understand it. Step 2. Identify the key levers. You must write down the 2 or 3 key performance indicators, KPIs, that truly drive this business's success. For a railroad, it might be carloads and revenue per ton mile. For a social media company, it might be daily active users and average revenue per user. For a retailer, it's same-store sales and inventory turnover. If you don't know the critical variables that determine success or failure in that specific industry, you are flying blind. Your checklist must say, I have identified and written down the 3 most important KPIs for this business. Step 3. Articulate the risks. You must be able to list, without looking them up, the top 3 biggest threats to this company's future profits. Is it a new technology that could make their product obsolete? Is it a powerful competitor? Is it a change in government regulation? Is it a reliance on a single supplier or customer? Thinking about what could go wrong is more important than fantasizing about what could go right. This forces you to engage in what Charlie Munger calls inversion. Step 4. The power of number. Your checklist needs a final, brutal question. After answering the above on a scale of 1 to 10, how high is my confidence that I have a genuine, durable, informational, and analytical edge over the average market participant when it comes to this specific company? Be brutally honest. If the answer is not an 8, 9, or 10, the answer is no. You close the file and move on. There are thousands of publicly traded companies. Your job is not to have an opinion on all of them. It is to find the handful where you have a genuine advantage. This process is not about being smart. It's about knowing the boundaries of your own intelligence. Now let's explore the antithesis, the path of the 99% of investors who ignore this fundamental pillar. This is the path of the story chaser, the hot tip buyer. Imagine a typical retail investor, let's call him Dave. Dave is a smart guy, an engineer at his day job. He hears about a company called Quantum Leap AI. The story is incredible. They are developing a revolutionary artificial intelligence platform that will change everything from drug discovery to financial modeling. The CEO is a charismatic visionary who gives incredible interviews. The stock is up 300% in the last 6 months. Dave's friend, who knows nothing about technology, told him he made $10,000 on it. The FOMO kicks in hard. Dave starts his research. He goes on social media and finds a community of bulls who are all convinced the stock is going to the moon. This is confirmation bias in action. They post charts showing the meteoric rise and talk about diamond handing it. Dave reads the company's investor presentation, which is filled with impressive-sounding jargon like synergistic neural networks and multimodal data ingestion. He doesn't really understand what it means, but it sounds brilliant. He never asks the simple question, how, specifically, will you make money from this? He never investigates the competition. He doesn't know that Google, Microsoft, and Amazon are pouring billions into their own AI research with armies of PhDs. He doesn't look at the company's financial statements, which would show they are burning through hundreds of millions of dollars a year with negligible revenue. He has no idea what a realistic timeline for profitability might be. He doesn't understand the business, he understands the story. So, Dave buys. He invests a significant chunk of his savings near the peak of the hype cycle. For a few weeks it feels great. The stock drifts a little higher, he feels like a genius. Then, the company releases its quarterly earnings. the losses are wider than expected. They announce they need to raise more capital by issuing new shares, diluting existing shareholders like Dave. The stock drops 30% in a day. The narrative starts to crack. A competitor announces a breakthrough. The charismatic CEO sells a large portion of his shares. The stock falls another 50%. Dave, who bought on a story, now has no framework to make a decision. He doesn't know if the company is now a bargain or a sinking ship, because he never understood its fundamental value in the first place. He either sells in a panic, locking in a massive loss, or he holds on, praying for a rebound that never comes. This is the fate of the investor who steps outside their circle of competence. They are adrift in an ocean of noise, with no anchor of knowledge to hold them steady. The direct financial connection between the circle of competence and your portfolio is profound and tangible. When you operate firmly within your circle, your ability to analyze a company's financial statements transforms from a simple accounting exercise into a strategic evaluation. For example, anyone can look at an income statement and see rising revenue, but an investor who understands the business, let's say a software-as-a-service company, can look deeper. They will ask, is this revenue growth coming from acquiring new customers or from increasing revenue from existing customers? Net dollar retention. They know that the latter is far more valuable and indicative of a strong product and a sticky customer base. They can look at the cash flow statement and not just see cash from operations, but understand why it's changing. Is it because of favorable changes in working capital, or is it due to a fundamental improvement in the profitability of the core business? This deep understanding allows you to separate high-quality earnings from low-quality, accounting-driven earnings. Furthermore, this principle is the bedrock of any credible valuation. The process of projecting a company's future cash flows, the core of a discounted cash flow, DCF analysis, a key tool in value investing, is an act of pure guesswork if you are outside your circle. But if you deeply understand the industry, the competitive landscape, and the company's specific moat, your projections, while still imperfect, have a much higher probability of being in the right ballpark. This dramatically improves your decision-making. It allows you to confidently buy when the price is low because your valuation is based on a deep understanding of the business's long-term earning power, not on the market's fickle mood. This discipline directly translates into superior long-term returns and, crucially, robust risk management. The biggest financial risks don't come from stock market volatility. They come from paying a high price for a business whose fundamentals you do not understand. Staying within your circle is the first and most important step in building a resilient, all-weather portfolio designed for sustainable wealth building, not for speculation. Once you have established that a potential investment lies squarely within your circle of competence, you arrive at the second, and perhaps most famous, pillar of the Buffett-Munger philosophy, the search for a durable competitive advantage, or what Buffett colorfully calls the moat. A business, like a medieval castle, is constantly under siege. Competitors are always trying to storm the walls, steal the customers, and capture the profits. A moat is a structural advantage that protects the castle from these invaders. It's what allows a company to earn high returns on capital for long periods of time. A checklist that doesn't rigorously test for the existence and durability of a moat is inviting disaster. It's the equivalent of buying a beautiful castle built in the middle of an open field with no walls, no crocodiles, and no archers. It looks great today, but it's only a matter of time before it's overrun. The story that perfectly encapsulates the power of identifying a moat in a time of crisis is Buffett's legendary investment in American Express during the great salad oil scandal of 1963. A company called Allied Crude Vegetable Oil, a major customer of a warehousing division of American Express, was discovered to be perpetrating a massive fraud. They had secured huge loans using barrels of salad oil as collateral. The problem was, the barrels were mostly filled with water. When the fraud was uncovered, Allied Crude went bankrupt, and American Express was on the hook for potentially catastrophic losses, estimated at the time to be as high as $175 million, a figure that would have wiped out the company's net worth. Wall Street panicked. The consensus was that American Express was finished. the stock, which had been trading at over $60 a share, plummeted to $35. The story was toxic. Fear was everywhere. But Warren Buffett, then a young, relatively unknown money manager in Omaha, decided to step outside the panic and apply his checklist. He understood the business. His next question was, has this scandal damaged the company's fundamental moat? He didn't just look at the numbers, he did the legwork. He went to restaurants and travel agencies, he talked to merchants. He would ask them, if we stopped taking the American Express card, would it affect your business? They would look at him like he was crazy. Of course it would. Their best customers used the Amex card. He asked them if they were considering switching to a rival card because of the scandal. They weren't. Then he went to banks and observed people buying traveler's checks. He saw that they were still overwhelmingly buying American Express traveler's checks, not the ones from Bank of America or First National City. What he discovered was that the salad oil scandal, while a huge financial hit, had done absolutely nothing to damage the two powerful moats American Express possessed. The first was the brand, a global symbol of trust and affluence. The second was the network effect of its charge card and traveler's check system. Millions of cardholders wanted to use it, so millions of merchants had to accept it, which in turn made more people want the card. The scandal was a one-time financial problem in a small division of the company, but the core castle was untouched. He concluded the market was reacting emotionally to the headline risk and completely mispricing the long-term value of the business. He famously invested 40% of his partnership's capital, a massive bet, into American Express stock. Over the next few years, as the company absorbed the losses and the power of its moat reasserted itself, the stock price soared. The investment was a home run, cementing his reputation and providing a foundational lesson. In times of panic, the market sells indiscriminately, but the intelligent investor focuses on the durability of the moat. The psychological principles at play here are recency bias and the halo effect, both of which clouded the judgment of the investing public in 1963. Recency bias is our tendency to give more importance to recent events than to historic ones. The most recent, most vivid information in the minds of investors was the salad oil scandal. This single negative event was so powerful that it overshadowed decades of American Express's brand building and market dominance. They couldn't see the forest for the single burning tree. They extrapolated a short-term problem into a permanent impairment of the business. Buffett, by contrast, deliberately looked past the recent noise. His checklist forced him to ask about the long-term competitive position. He was asking questions about the next 10 years, not the next 10 days. This long-term perspective is a natural antidote to recency bias. The second bias is the halo effect. This is where our overall impression of a person, or in this case a company, is influenced by a single positive or negative trait. The scandal created a negative halo around American Express. Because one division was embroiled in a massive fraud, investors assumed the entire company was rotten, that its management was incompetent, and that its brand was permanently tarnished. They couldn't compartmentalize the problem, they painted the entire company with the same brush. Buffett's analytical process was the opposite. He deconstructed the company into its component parts. He recognized that the warehousing division was a small, peripheral business. The core businesses, the charge card and the traveler's checks, were separate and incredibly robust. He wasn't evaluating American Express, the scandal-ridden company. He was evaluating a collection of business units, identifying the crown jewels, and realizing that their value was being obscured by trouble in the servants' quarters. A checklist item that forces you to specifically identify and articulate the company's moat prevents you from falling for the halo effect. It forces you to look at the structure of the business, not just the sentiment of the market. It's a systematic way to separate temporary problems from permanent impairments. To apply this, we must build the moat analysis section of our investment checklist. This isn't just a yes or no question. It's a diagnostic tool to identify the type and strength of the competitive advantage. Your blueprint should have 4 main categories of moats, inspired by the work of investment research firm Morningstar. For any company you analyze, you must determine if it has a powerful moat in one or more of these areas. First, intangible assets. This includes brands, patents, and regulatory licenses. For your checklist, ask, does this company's brand allow it to charge a premium price for a product that is otherwise a commodity? Think of Coca-Cola versus a generic store-brand cola, or the price premium Tiffany & Company gets for its jewelry. Ask, does this company hold patents that prevent competitors from duplicating its product for a long period of time? This is crucial for pharmaceutical companies. A yes here is a strong indicator of a moat. Second, high switching costs. This exists when it is too expensive, time-consuming, or risky for a customer to switch from your product to a competitor's. Ask your checklist, would a customer face significant pain in moving to a rival? Think about your bank. Switching your checking account, with all its direct deposits and automatic payments, is a huge hassle. That's a switching cost. Or consider a company that uses Autodesk's architectural software. Retraining an entire team on a new system is prohibitively expensive. This is a very powerful and durable moat. Third, the network effect. This occurs when the value of a product or service increases as more people use it. The classic examples are credit cards like Visa or social networks like Facebook. The more people that use Facebook, the more valuable it is to you because more of your friends are on it. Ask your checklist, does this product become more useful to each user as the total number of users grows? If so, it creates a winner-take-all dynamic that is incredibly difficult for competitors to overcome. Fourth, cost advantages. This allows a company to produce a product or service at a lower cost than its rivals, allowing it to either undercut them on price or earn higher profit margins. This can come from proprietary technology, superior processes, or, most commonly, scale. Think of Walmart's immense logistical and purchasing power. Ask your checklist, does this company have a structural, sustainable cost advantage over its rivals? Be careful with this one. Cost advantages can sometimes be temporary. Your checklist should force you to not only identify the moat, but to score its strength and durability on a scale of 1 to 10. A company with multiple types of moats, like Apple, brand, switching costs, network effect in its ecosystem, is a fortress. The antithesis to this disciplined search for a moat is the all-too-common path of chasing companies in highly competitive, commoditized industries. This is the investor who gets excited about a good quarter from a company with no pricing power and no unique advantage. Let's take the airline industry as a classic example. For decades, it has been a notorious destroyer of capital. An investor, let's call her Sarah, sees that a specific airline, Flycheap Air, just reported record profits. Fuel costs were down, travel demand was up, and the stock looks cheap on a trailing price-to-earnings basis. She gets excited. The story is good. Travel is back. She buys the stock. What her checklist would have revealed had she used one is that Flycheap Air has no moat. None. Its brand is meaningless. Customers will almost always choose the cheapest flight on Kayak or Expedia. There are no switching costs. You can fly a different airline for every trip with zero friction. There is no network effect. There is no sustainable cost advantage. A new upstart can lease planes and enter its most profitable routes tomorrow, starting a price war that will evaporate everyone's profits. The airline industry is a brutal battle for survival where the only weapon is price. The high profits Sarah saw were a temporary result of favorable cyclical conditions. Low fuel, high demand. They were not the result of a durable business quality. As soon as fuel prices rise or a recession hits, a brutal price war will begin, and those record profits will turn into staggering losses. Sarah bought a business that looks like a castle but is in reality a tent. It provides shelter when the weather is calm, but it will be shredded in the first storm. By ignoring the question of the moat, she confused a cyclical upswing with a great business. This is a critical distinction. A great business earns high returns on capital throughout the business cycle. A mediocre business in a commoditized industry is simply a cork bobbing on the waves of the broader economy. Investing in the latter is a speculation on macro trends, not a long-term investment in a superior enterprise. The financial connection between a durable competitive advantage and your portfolio's performance is the most direct and powerful in all of investing. The moat is what allows a business to become a true compounding machine. A company with a strong moat will consistently generate high returns on invested capital, ROIC. ROIC is a measure of how effectively a company is using its money to generate profits. A company that can consistently earn, say, 20% on its invested capital has a powerful engine for creating value. It can reinvest its profits back into the business at that same high rate, creating a compounding effect that is like a snowball rolling downhill. This shows up directly in the financial statements. You will see consistently high and stable gross margins because the company has pricing power and doesn't have to compete solely on price. You will see a strong and growing stream of free cash flow because the business is profitable and doesn't require endless capital expenditures just to stay competitive. In contrast, a company without a moat will see its ROIC trend towards its cost of capital. Competition will inevitably drive down prices and drive up costs for marketing, R&D, etc., eroding profitability. Their margins will be volatile and unpredictable. They might have a good year or two, but the forces of capitalism will prevent them from sustaining high returns. When you conduct your stock analysis, looking for a history of high and stable ROIC is a quantitative proxy for identifying a qualitative moat. This financial discipline is central to effective portfolio management. By filling your portfolio with businesses that possess these deep structural advantages, you are not just buying a collection of stocks. You are acquiring fractional ownership in a fleet of the world's best compounding machines. This is the surest path to long-term wealth building. It shifts the odds dramatically in your favor, moving you away from the speculative chase for short-term gains and toward the patient accumulation of wealth through ownership of superior enterprises. Having confirmed that a business is both understandable and protected by a durable moat, we arrive at the third pillar of our checklist, a factor that is often overlooked by quantitative-focused investors, but is of paramount importance to masters like Buffett: the quality and integrity of management. You are not just buying a set of assets in a market position, you are entrusting your capital to the people who will be making decisions with it every single day. A brilliant business can be run into the ground by foolish or dishonest managers, while a great management team can elevate a good business to legendary status. Your checklist must therefore have a section dedicated to judging the jockeys, not just the horse. There is no better illustration of Buffett's focus on management than his relationship with the Blumpkin family of Nebraska Furniture Mart. In 1983, Buffett bought a 90% stake in the company. The story is the stuff of legend. He went to meet the matriarch, Rose Blumpkin, known to everyone as Mrs. B. She was a Russian immigrant who had started the business in a basement in 1937 with a $500 loan and built it into the largest home furnishing store in North America, doing over $100 million in sales. Buffett was astounded by her business acumen, her relentless focus on low prices, and her absolute integrity. The negotiation was famously simple. Buffett asked her for the price. She named a number, around $60 million. He said yes. There were no audited financials. There were no teams of investment bankers doing due diligence. The entire deal was done on a 2-page contract and a handshake. Why? Because Buffett's checklist for management was overwhelmingly satisfied. He saw in Mrs. B an owner-operator who treated the company's money like her own, who was passionate about her customers, and who was a phenomenal capital allocator, even if she didn't use the term. He was betting on her. The story gets even better. After the sale, Mrs. B continued to run the store with the same fanatical energy. Years later, at the age of 95, she was forced into retirement by her grandsons. Unhappy with being idle, she promptly set up a rival store right across the street called Mrs. B's Clearance and Factory Outlet. It quickly became so successful that it started taking significant business away from Nebraska Furniture Mart. Buffett, recognizing a good thing when he saw it, had Berkshire Hathaway acquire Mrs. B's new company and put her back in charge. The lesson is profound. Buffett's investment was not in a furniture store, it was in Rose Blumkin. He knew that with her at the helm, his capital was not only safe, but was in the hands of a business genius who would treat him as a true partner. His management checklist looks for 3 key traits: integrity, talent, and a shareholder-oriented mindset. He wants managers who are honest, who love the business, and who think about allocating capital rationally to maximize long-term value for the owners. The psychological trap that a management checklist helps you avoid is authority bias, combined with a susceptibility to charismatic storytellers. Authority bias is our natural tendency to trust and be influenced by figures of authority. A CEO of a publicly traded company is a powerful authority figure. They wear a suit, they speak confidently on television, they are surrounded by the trappings of success. We are hardwired to believe what they say. If a CEO says the future is bright and a new acquisition is synergistic, our default setting is to accept it at face value. A checklist forces you to distrust and verify. It replaces passive acceptance with active investigation. It makes you ask, what is this CEO's actual track record, not just their rhetoric? It forces you to look at their past decisions and see if they were, in fact, shareholder-friendly. The second danger is the charismatic leader. Humans are drawn to compelling narratives and confident visionaries. A CEO who can spin a great story about changing the world can attract a cult-like following among investors. Think of Adam Neumann at WeWork. He sold a vision of a global community and a higher state of consciousness, all while running a simple office rental business with horrific unit economics. Investors, mesmerized by his charisma, poured billions into the company, ignoring clear red flags in the financials and glaring instances of self-dealing where Neumann enriched himself at the company's expense. They fell in love with the storyteller and forgot to analyze the business or the character of the person running it. A rigorous management checklist is the antidote to this. It forces you to look past the charisma and focus on the cold, hard facts. It asks questions about compensation, capital allocation, and past behavior. It's a tool for seeing the person behind the curtain, not just the grand performance on stage. It grounds your analysis in the reality of past actions, which are a far better predictor of future behavior than any grandly articulated vision. So how do you build the management due diligence section of your checklist? This is your blueprint for evaluating the people in charge. It is a forensic examination of their character and competence, using public documents as your evidence. Step 1. Read the shareholder letters. Go back and read the last 10 years of the CEO's annual letters to shareholders. This is the single best window into the mind of management. Your checklist should ask, is the letter clear, candid, and straightforward, or is it filled with corporate jargon, buzzwords, and self-congratulatory fluff? Does the CEO openly discuss mistakes and what was learned from them? Or do they blame poor results on external factors? Great managers, like Buffett, write clear, honest letters that treat you like a partner in the business. Poor managers write marketing documents designed to obscure reality. Step 2. Analyze capital allocation. This is the CEO's most important job. Your checklist must ask, what has management done with the company's free cash flow over the past decade? Have they reinvested it in high-return projects within the business? Have they made smart, strategic acquisitions at reasonable prices? Or have they engaged in unrelated businesses they don't understand? Have they bought back shares? If so, was it done opportunistically when the stock was undervalued, or was it done at peak prices just to prop up earnings per share? A history of value-destructive acquisitions or poorly timed buybacks is a massive red flag. Step 3. Scrutinize executive compensation. Find the proxy statement and look at how the top executives are paid. Your checklist must ask, is the compensation plan simple and tied to long-term business performance? Or is it a complex mess of bonuses and stock options tied to short-term metrics that can be easily manipulated? The ideal compensation plan aligns the interests of management with the interests of long-term shareholders. Look for incentives tied to metrics like return on invested capital or growth in intrinsic value per share, not just stock price or quarterly earnings. A CEO who gets rich only when you get rich is a CEO you want to partner with. If these three tests aren't passed with flying colors, it should be a serious mark against the company, regardless of how good the business appears to be. The antithesis of this careful approach is the investor who completely ignores the management factor. They are the ones who are repeatedly burned by what they call bad luck, but is actually a predictable outcome of partnering with the wrong people. Consider an investor looking at a company we'll call Acquire Corp. The business looks statistically cheap. It's trading at a low P/E ratio and seems to be growing quickly through acquisitions. The CEO is always on the news talking about the next big deal. Our investor, focusing only on the numbers, buys in. What he fails to investigate is the tree and quality of that growth. His management checklist would have forced him to look at Acquire Corp's history of capital allocation. He would have discovered that the company has been on a decade-long buying spree, consistently overpaying for other companies. They issue enormous amounts of new stock and take on huge debt to fund these deals. The CEO's compensation is tied to revenue growth and the size of the company, not profitability or return on investment. This creates a perverse incentive for him to be an empire builder, constantly buying other companies to make his own domain larger, regardless of whether the deals make economic sense for shareholders. The low P/E ratio is a mirage. The earnings, are inflated by accounting tricks related to the acquisitions and are not representative of true, sustainable cash flow. The company is a house of cards, built on debt and a stream of ever larger, ever more desperate acquisitions. Eventually, the music stops. They make one bad deal too many, the debt load becomes unmanageable, or the market sours on their strategy, the stock collapses. The investor who ignored the management question is left holding the bag, having mistaken a value-destroying empire builder for a shrewd capital allocator. He learned a painful lesson. When you invest in a company run by a manager with incentives that are misaligned with your own, you are destined to be the loser in the relationship. The direct financial connection between management quality and your investment returns is concrete and measurable. Excellent management manifests on the balance sheet and cash flow statement in several key ways. First, a shareholder-friendly management team maintains a prudent balance sheet. They avoid excessive leverage, understanding that debt can be fatal in a downturn. You will see a strong cash position and a manageable debt-to-equity ratio. This financial conservatism provides resilience and flexibility, allowing the company to play offense during market panics while competitors are struggling to survive. Second, superior capital allocation shows up in a consistently high and growing return on equity, ROE, and return on invested capital, ROIC, achieved without resorting to dangerous levels of debt. A great CEO is obsessed with earning high returns on the capital they control. This financial discipline is the engine of compounding intrinsic value over the long term. Third, integrity and transparency are reflected in the quality of financial reporting. A trustworthy management team provides clear, straightforward financial statements and commentary. They don't play accounting games or try to obscure bad news. This reduces the risk of nasty surprises and increases your confidence in your own analysis. A bad management team, on the other hand, leaves a trail of financial destruction. You'll see a debt-laden balance sheet from reckless acquisitions. You'll see ROE propped up by excessive leverage, a fragile situation that can unravel quickly. You'll see a history of one-time write-offs and restructuring charges that seem to happen every year. By making the evaluation of management a non-negotiable part of your investment process, you are actively managing a critical, often overlooked risk. You are ensuring that your capital is not just in a good business, but in good hands. This is a vital component of any strategy aimed at serious, long-term wealth building and is a hallmark of sophisticated executive decision-making. We now arrive at the fourth, and for many, the final and most critical pillar of the investment checklist. You can find an understandable business with a deep moat and a brilliant management team, but if you pay too much for it, your investment returns will be mediocre at best and disastrous at worst. This is the principle of the margin of safety, famously articulated by Buffett's mentor, Benjamin Graham. The philosophy is captured in Buffett's own words: price is what you pay, value is what you get. Your job as an investor is to determine the value of the business and then, with unwavering discipline, wait to buy it at a price that is significantly below that value. That discount, that gap between price and value, is your margin of safety. It is the cushion that protects you from bad luck, unforeseen events, and, most importantly, errors in your own judgment. The quintessential example of Buffett's application of this principle is his 1973 investment in the Washington Post Company. At the time, the market was in the grip of a brutal bear market. The Nifty 50 growth stocks had collapsed, and sentiment was abysmal. Newspaper stocks in particular were deeply out of favor. Wall Street saw them as old media dinosaurs. The Washington Post Company's stock had fallen to the point where its entire market capitalization was just $80 million. But Buffett, applying his checklist, looked past the market sentiment and did the work to calculate the company's intrinsic value. He analyzed its assets piece by piece. The company owned not just the famous newspaper but also Newsweek magazine, several highly profitable network-affiliated television stations, and other properties. Buffett conservatively estimated that the television stations alone were worth more than the entire company's market price. He calculated that the private market value of all the company's assets, if sold off separately, was somewhere between $400 million and $500 million. And yet, he could buy the whole enterprise in the stock market for just $80 million. He was being offered the chance to buy $1 worth of prime assets for just 20 cents. This was a colossal margin of safety. The business didn't have to grow for him to make money. The management didn't have to be superhuman. The price was so ridiculously low compared to the provable, underlying value that the risk of permanent capital loss was minuscule. He invested heavily. Over the next decade, the value of those assets became apparent to the market, and the stock price soared more than 100-fold, becoming one of the cornerstones of Berkshire Hathaway's fortune. The lesson is clear. A great investment is not just about finding a great business, it's about finding a great business at a great price. The margin of safety is the bridge between the two. The psychological biases that the margin of safety principle is designed to conquer are anchoring bias and the powerful pull of herd mentality. Anchoring bias is our cognitive tendency to rely heavily on the first piece of information offered when making decisions. In investing, we often anchor to a stock's recent high price. For example, if a stock was trading at $200 a year ago and has fallen to $100, many investors will perceive it as cheap or a bargain, simply because it's 50% off its high. They have anchored their perception of value to the previous peak price. They buy the stock without ever doing the work to determine if its intrinsic value is actually $50, making the current price of $100 still wildly expensive. The margin of safety framework forces you to ignore these irrelevant anchors. It demands that you calculate an independent estimate of intrinsic value first. Your anchor becomes your own calculated value, not the market's arbitrary price history. This completely reframes the decision. The question is no longer, is it cheap relative to its past, but is it cheap relative to what it's actually worth? The second bias is herd mentality. Humans are social creatures, and we find comfort and validation in doing what everyone else is doing. When a stock is popular and its price is rising, being part of the crowd feels good and safe. Buying it provides social proof. Conversely, buying a stock that is hated, ignored, and falling in price is psychologically painful. It feels lonely and contrarian. It makes you question yourself. The margin of safety discipline forces you to be a contrarian. By definition, a large discount to intrinsic value is most often found in assets that the herd has discarded. It requires you to buy when others are fearful and to sell when they are greedy. It provides a rational, logical reason to stand apart from the crowd. Your conviction comes not from the agreement of others, but from your own analysis and the size of your discount. It is the ultimate tool for rational, independent thought in an arena often dominated by mass emotion. Creating the margin of safety section of your checklist is the ultimate test of your financial discipline. This is where you translate your analysis into a concrete buy/sell decision. Here is a practical blueprint. Step 1. Calculate a range of intrinsic value. Value is not a single precise number, it's a fuzzy range. You should use a few different simple methods to triangulate a conservative estimate. You could use a multiple of average owner earnings over the past 5 to 10 years. You could use a conservative free cash flow multiple. You could estimate the company's liquidation value if it's an asset-heavy business. The key is to be conservative in your assumptions. Always assume lower growth rates and lower margins than the company has historically achieved. As Buffett says, it's better to be vaguely right than precisely wrong. Your checklist must state, I have calculated a conservative range for the intrinsic value of this business. Step 2. Define your required margin of safety. This is your non-negotiable discount. For a stable, predictable, high-quality business, you might require a 30% margin of safety. This means you will not buy until the stock price is 30% below your low-end estimate of intrinsic value. For a more cyclical or less predictable business, you might demand a 50% margin of safety. This number should be written down in your investment plan and on your checklist. It is your bright red line. Step 3. The final checkbox. The final item in this section is a simple binary question. Is the current market price at or below my predetermined purchase price? Intrinsic value minus margin of safety. Yes/no. If the answer is no, the process stops. It doesn't matter how much you love the company. You put it on a watch list and wait patiently. Patience is a key component of this strategy. You are waiting for the market to make a mistake and offer you a price that provides you with a significant margin of safety. This mechanical rule prevents you from fudging your numbers or getting impatient and overpaying. It is the final gatekeeper that protects your capital. The antithesis, the path of the 99%, is the growth at any price investor. This mindset was on full display during the bull market of 2020 and 2021. Investors became convinced that for certain types of companies, usually in technology, valuation didn't matter. The narrative was that these companies were growing so fast and their total addressable markets were so large that any price was justified. They completely abandoned the concept of a margin of safety. They were buying stories about the future, with no regard for the price being paid in the present. Let's imagine an investor, Tom, who got caught up in this mania. He finds a software company, Future Corp, that is growing revenues at 100% a year. The story is fantastic. The market loves it. The stock is trading at 50 times annual revenue, not 50 times earnings. The company is losing enormous amounts of money. 50 times sales. Tom knows this is historically expensive, but he tells himself, this time is different. He sees others getting rich, and the herd mentality takes over. He doesn't even attempt to calculate intrinsic value. The concept seems quaint and irrelevant. He has no margin of safety. In fact, he has a margin of danger. He is paying a price that assumes decades of flawless execution and massive growth, with no room for error. Then, the environment changes. Interest rates rise. The market's appetite for unprofitable growth stocks vanishes. Future Corp's growth rate slows from 100% to 40%. This is still a fantastic growth rate, but it's not what the stratospheric valuation was priced for. The narrative shatters. The stock collapses, falling 80 to 90% from its peak. Tom is devastated. The company may still be a good business, but he bought it at such an insane price that he may never get his money back. He learned the most painful lesson in investing. No matter how wonderful the business, there is a price at which it becomes a terrible investment. The margin of safety is not just a tool for value investors, it is a universal principle of risk management. Ignoring it is like a high-wire walker deciding to forego a safety net because they feel confident. It works, until it doesn't, and the result is catastrophic. The financial connection between the margin of safety in your portfolio is direct and twofold. First and foremost, it is your primary defense against the permanent loss of capital. All investors make mistakes. You will misjudge a company's moat. You will be wrong about a management team. You will incorrectly forecast future earnings. A margin of safety provides a buffer that can absorb the impact of these errors. If you buy a business worth $100 per share for $60, and you later realize it's only worth $80 per share, you haven't lost money. You still made a decent investment. If, however, you had paid $95, your error would have resulted in a loss. This is the ultimate tool for risk management and capital preservation. The second financial benefit is that it is the source of superior returns. An investment's return is not determined by a company's growth, but by the relationship between the price you pay and the value you receive. By buying at a significant discount, you create two ways to win. You profit from the normal growth in the intrinsic value of the business over time, and you get an additional kicker as the price reverts from your discounted purchase price back up to its full intrinsic value. This combination is what generates the exceptional long-term compound annual growth rates that value investing is known for. A disciplined asset allocation strategy, where capital is only deployed when a sufficient margin of safety is present, is the most reliable way to build wealth over the long term. It forces you to be patient, rational, and countercyclical, ensuring that you are buying low and selling high, the very essence of a successful investment process. This leads us to our fifth and final pillar, a concept that acts as a powerful guardian for the entire checklist. It is the idea of inversion, of creating an anti-checklist. While the first four pillars tell you what to look for, this one tells you what to avoid at all costs. It's a list of automatic disqualifiers, deal breakers, that immediately allow you to say no and move on, saving you countless hours of analysis and protecting you from situations that are statistically likely to end in disaster. Charlie Munger, Buffett's longtime partner, is the master of this way of thinking. He famously says, "All I want to know is where I'm going to die, so I'll never go there." Applied to investing, this means instead of only asking, "What makes a great investment?" you should also ask, "What makes for a truly terrible investment, and how can I make sure I never buy one?" This leads to identifying a set of red flags that are so dangerous they warrant immediate disqualification. The genesis of this thinking can be seen in Buffett's own evolution as an investor. In his early days, he practiced what he called cigar butt investing. He would look for terrible companies that were trading for less than their net working capital. He was buying a dollar for 50 cents, but the dollar itself was melting. His purchase of Berkshire Hathaway, then a failing New England textile mill, was a classic example. He made money on it, but he realized it was an immense struggle. He learned that it is far better to buy a wonderful company at a fair price than a fair company at a wonderful price. Some businesses, he concluded, are in industries that are so bad or have balance sheets that are so broken that they belong in the too hard pile. No matter how cheap they look, the odds are stacked against you. An anti-checklist formalizes this too hard pile. It's a pre-commitment to avoid certain types of trouble. The psychological principle that the anti-checklist neutralizes is a combination of the narrative fallacy and overconfidence bias. The narrative fallacy is our tendency to be swayed by a good story. We are particularly susceptible to turnaround stories. The idea of buying a beaten-down company at its point of maximum pessimism and riding it back to glory is incredibly appealing. It makes us feel like savvy, contrarian geniuses. We fall in love with the narrative of a new CEO coming in to save a dying company or a forgotten brand being revitalized. This narrative can blind us to the brutal underlying reality that most turnarounds don't turn. The second bias is overconfidence. Many investors, especially intelligent ones, believe they are the exception. They see a company with a mountain of debt and a broken business model and think, yes, this is risky for most people, but I'm smart enough to see the hidden value. I can figure this out when no one else can. They are drawn to complexity and difficulty as a way to prove their own prowess. An anti-checklist is a powerful dose of humility. It's an admission that some problems are simply not worth trying to solve. It acts as a brake on our own hubris. It forces us to acknowledge that, while we might be smart, we are still operating in a world of uncertainty. By pre-committing to avoid certain statistically terrible situations, like companies with massive debt loads or those in structurally declining industries, we save ourselves from our own worst impulses. It's a system designed to protect us from our own cleverness, which can often be our greatest enemy in investing. So let's build the blueprint for your automatic number anti-checklist. This section should be at the very top of your overall investment checklist. If a company triggers any of these, you stop the analysis immediately. Here are 5 powerful items for your anti-checklist. First, the debt bomb. Your checklist should ask, does the company have a history of unprofitability combined with a high and rising debt load? This is the classic recipe for bankruptcy. A company that cannot fund its operations with its own cash flow and must constantly borrow money is living on borrowed time. This should be an automatic no. Second, the black box. Ask, is the business model or the financial reporting so complex that I cannot understand it? This includes many complex financial firms, insurance companies with opaque derivative books, or companies with a history of aggressive accounting. If you can't understand how they make money or trust their financial statements, you must pass. Don't let your ego convince you to play a game where you don't know the rules. Automatic no. Third, the value destroyer. Ask, does management have a long track record of value-destructive acquisitions or foolish capital allocation? You can look at their history. If they have consistently overpaid for deals that have not panned out, they have proven they cannot be trusted with your capital. Past behavior is the best predictor of future behavior. Automatic no. Fourth, the commodity trap. Ask, is this a business in a fiercely competitive, commoditized industry with no sustainable competitive advantage? This includes most airlines, restaurants, generic retailers, and many manufacturing businesses. While you can occasionally make money on these, the odds are against you in the long run. For most investors, it's best to just avoid the entire category. Automatic no. Fifth, the hype machine. Ask, is the primary reason for my interest in this stock based on a macroeconomic story, a hot trend, or a paradigm shift? This could be anything from 3D printing to cannabis stocks to the metaverse. When the story is more prominent than the business fundamentals, it's a speculation, not an investment. Automatic no. This anti-checklist acts as a bouncer at the door of your portfolio, turning away the most likely troublemakers before they can ever get inside. The antithesis of this disciplined avoidance is the investor known as the bottom fisher. This is the person who is magnetically attracted to stocks that have fallen 90% or more. Their logic is deceptively simple. How much lower can it go? They see a stock that was once $100 and is now $10 and believe it's an automatic bargain. They fail to understand that a stock that falls 90% can fall another 90%. That $10 stock can easily become a $1 stock and then zero. Let's imagine an investor, Mark, who sees Old World Inc., a chain of physical bookstores, trading at an all-time low. He remembers when the stores were popular. He sees the stock is down 95% from its peak. He thinks this is a classic value play. He buys a large position. What his anti-checklist would have told him is that Old World Inc. fails on multiple counts. It's in a commodity trap. It's competing with Amazon, an unstoppable force with massive cost advantages. It likely has a huge debt load from trying to stay afloat. It is in an industry in terminal decline. The fact that the stock is cheap is irrelevant. It is what Ben Graham called a, quote, value trap. The business is cheap for a very good reason. It is dying. Mark isn't buying a discounted asset. He is catching a falling knife. He is trying to solve a problem that is in the too hard pile. His capital is slowly but surely incinerated as the company's intrinsic value erodes year after year, eventually heading towards bankruptcy. The bottom fisher confuses cheapness with value. The intelligent investor with an anti-checklist understands that some things are cheap for a reason, and that the most important thing is not just to find winners, but to avoid the certain losers. The financial connection of the anti-checklist is the most direct form of risk management imaginable. Its sole purpose is capital preservation. By implementing a strict set of automatic no criteria, you are systematically eliminating the investments that have the highest probability of resulting in a total or near-total loss of capital. A single zero in your portfolio can do catastrophic damage. If you have a portfolio of 10 stocks and one goes to zero, you need one of your other stocks to double just to get back to even on that position. Avoiding the big losers is often more important than picking the big winners. This is the financial equivalent of the Hippocratic Oath. First, do no harm. Your anti-checklist ensures that you avoid companies with existentially threatening balance sheets. A company with too much debt is fragile. A small business downturn or a rise in interest rates can trigger a solvency crisis, wiping out equity holders completely. Your anti-checklist also ensures you avoid businesses with no moat, which are susceptible to margin compression and eventual unprofitability. This directly protects your long-term compounding rate. The path to financial freedom is a marathon, not a sprint. It's about consistently earning good returns and, crucially, avoiding the major setbacks that force you to start over. The anti-checklist is your ultimate defense, a simple but powerful tool for avoiding mistakes and ensuring your wealth-building journey stays on track, protecting you from the most common and devastating pitfalls that trap the average retail investor. So there you have it, the 5 pillars of a powerful investment checklist, a system that forces you to confirm you are within your circle of competence. A rigorous test for a durable competitive moat, a deep dive into the integrity and talent of management, an unwavering discipline to demand a margin of safety, and a powerful anti-checklist to avoid the traps that destroy capital. You have just been given the blueprint for an intellectual machine, a systematic process that strips emotion, narrative, and hype out of your investment decisions, replacing them with logic, discipline, and a profound respect for risk. The act of building and using this tool will fundamentally change your relationship with the market. It will transform you from a passive speculator into an active, intelligent business owner. This checklist is your shield, your firewall, and your compass. It is the single most powerful thing you can do to reduce errors, improve your returns, and put yourself on the path to true and lasting financial independence. You have invested your time, your most valuable asset, in absorbing this entire framework. You now possess a mental tool that the vast majority of market participants will never discover. You have the complete architecture for a decision-making process that can protect and grow your capital for decades to come. This is not just information. It is a fundamental upgrade to your financial operating system. But what you have just mastered is one crucial piece of a much larger puzzle. This checklist is the ultimate defensive weapon. It is the fortress you build to protect what you have. It tells you what to buy, ensuring that every asset that enters your portfolio is of the absolute highest quality and purchased at the right price. However, a fortress, no matter how strong, is a static defense. The other half of the equation, the offensive strategy, involves a different set of skills. How do you find the great companies to run through this checklist in the first place? Where do you hunt for opportunities? How do you recognize the specific market conditions that create the very margin of safety your checklist demands? The system of a master investor is a network of interconnected mental models. The checklist is the what, but there is also the how and the when. The video that is now appearing on your screen is designed to be the missing link. It is the next piece of the map. It bridges the gap between knowing what a great investment looks like and knowing how to systematically find them in the wild. It connects the defensive discipline you've just built with the proactive, opportunity-seeking mindset of the world's greatest capital allocators. The choice you have right now is more than just what to watch next. It is a decision about your own identity as an investor. Are you content to simply have a strong shield? Or do you want to complete your arsenal with a powerful sword? Are you satisfied with simply avoiding mistakes? Or do you want to learn the methods for proactively seizing moments of opportunity? The journey to mastery requires a complete set of tools. The next one is waiting for you. Continue your ascent. Click and complete your mental arsenal.